Hey viewers, today we are going to cover financial reporting. We'll answer the question from financial reporting September-December 2020 exam from ACCA. Let's go to the question. We'll cover question Loudon core scenario 1. So let's go to the requirements. The requirements read as follows. A. Prepare a schedule of adjustment required to the retained earnings of Loudon Co. as at 30 September 20x8 as a result of the information in notes 1 to 4, 8 marks. B. Prepare the statement of financial position of Loudon Co. as at 30 September 20x8. Note, the notes to the statement of financial position are not required. All calculations should be rounded to the nearest thousand. Now, let's do the adjustment first to the retained earnings, then we'll follow by the statement of financial position. So we are told here that note 1, 2, 3, 4 needs to be considered to revise the retained earnings. So let's go to the question. Loudon Co. has presented a draft statement of profit or loss for the year ended 30 September 20x8 before any adjustment required by notes 1 to 4 below. The draft profit has been added to retained earnings, and the summarized trial balance of Loudon Co. as at 30 September 20x8 is. Here we are given the trial balance where we have got equity shares, retained earnings that we need to adjust. So we have encountered retained earnings. So we'll say retained earnings as per the trial balance TP. The retained earnings as per the trial balance is 4122. We need to adjust that. We need to adjust that figure. So we'll say adjustments. So when we are reading note 1 to 4, if we encounter something that needs to go to retained earnings or profit for the year, we'll quickly take it to the adjustments column there. Now let's go to note number 1. Note number 1 is loan note. We are given here proceeds of 5% loan note. Note number 1, 5,000. Then a 5% loan note was issued on 1 October 20x7. That's the beginning of the year. At its face value of 5 million. This is 5,000 in thousands, so it's 5 million. Then direct costs of the issue amounted to 0.125 million and were charged to the profit or loss. The issue cost mustn't be charged to the profit or loss. The issue cost must be capitalized. So they were subtracted from the profit. Now we need to add them back. Issue costs of loan note. So it's 125 in thousands. We are all working in thousands here. Then the loan will be redeemed in 5 years' time at a substantial premium, which gives an effective interest rate of 8%. We know in the profit or loss account, we need to charge the effective rate, not the par value or the percentage that is used to pay the interest payments. We need to charge the finance cost at the effective interest rate. So now let's go down and put our workings here. So we start with the loan note. Then we say opening balance, because it was issued at the beginning of the year. So we'll say 5,000 less we offset the issue cost. So we say 5,000 less 125 issue cost. That's the opening. Then we have to charge the finance costs using the effective interest rate. So we'll say opening balance multiplied by 8%. We do not need to prorate that, as this was it was issued at the beginning of the year. Then we need to subtract the interest payment. We are given the interest payment of 250. That is the interest payment that we paid, that we see there as 250. So we subtract 250. Then after subtracting 250, we get the closing balance of the loan note. This closing balance will be transferred to the statement of financial position, but at the present moment we wanted the finance cost to adjust our profit here. So we'll say finance costs of loan notes. So we take that and reduce our profit by the finance cost. We are done with note number 1. Now let's go to note number 2. Note number 2, we are given non-current assets. The first non-current asset that we see here is the office buildings. Opening carrying value. I assume we have already read this. The opening carrying value. Let's go to our trial balance. The office building costs 20,000. Accumulated depreciation as at the beginning of the year is 4. So the opening carrying value is 20,000 less 4,000. That is 16,000. Then let's go back. On 1 April, we are now reading here. On 1 April, the building was deemed to be impaired as its fair value was estimated to be 12 million. So we need to find the depreciation from 1 October 20x7 up to 1 April 20x8. So we'll say October, November, December, January, February, March. That's 6 months. So we'll depreciate that by what? By 6 months. Current depreciation. So we'll say that figure, it was initially depreciated over 25 years. Then we multiply that by 6 divided by 12. We get 320. Then we need to sum that. This is the balance as at 1 April 20x8. Now we are told that it was impaired. So we have an impairment. Then we have got the fair value. At that same date, the fair value at that same date is 12 million. So it becomes 12,000 in thousands. So the impairment is 3,600. But we have only depreciated the asset for only 6 months. So we need to also depreciate again for the last 6 months. So we'll say 12 is now, the years are now reviewed to 12. So we'll divide by 12. Then we'll multiply by 6 divided by 12. We get our depreciation is that much. Then now we need to sum to get the closing balance or the carrying value at SFP date. Now we have got figures there, but we'll transfer once with the other asset. We are also told here that on 1 October, Loudon sold one of his factories with a carrying amount of 3 million, cost 5 million, accumulated depreciation 2 million for 3.5 million. The proceeds were credited to the suspense account. This is the suspense account. So they were debited to the bank and credited to the suspense account. So now we have got the factories. So we'll say here, factories, opening carrying value, opening carrying value CV. We go to our trial balance. We have got 40,000 less 11,100. We get the carrying value as that one. Then there was a disposal at the beginning of the year. The disposal at carrying value of 3 million, which is 3,000. Then the assets that were left that should be depreciated is that much. Then we need to depreciate. We are told that the factory is depreciated 15%, reducing balance method. So our current depreciation will be 25,900 multiplied by 15%. We get that depreciation. Then now we need to sum up to get the carrying value at the SFP date. Now we've got too much information that we need to transfer now to our statement, to our adjustments here. We have got depreciation. We have got depreciation of 320. We add again the depreciation of 500. We add again the depreciation of 3,885. We get that figure for depreciation. We also have got impairment. Let's go and get the figure. The impairment of 3680. We put it there. And the last piece of information we extracted from here. We were told that the asset was sold for 3.5, whereas the carrying amount is 3 million. So we have got a gain on disposal of 3,500 less 3,000. So we have got a gain of 500. Now let's move to note number 3. We are told that the Loudon has an obligation to clear environmental damage caused at one of its factories sites during 20X7. The cleanup is due to take place at the end of the factory's useful life. The liability has been accounted for appropriately, and the balance at 1 October 27 represents the correct present value at that date. Loudon has a cost of capital of 5%. So now let's go to the environmental provision. We have got environmental provision of that much. So let's put up the working environmental provision. We have got the opening opening provision is 1228. Then we need to unwind the discount of 5%. So we'll say that figure multiplied by 5%, we get 61. Then we sum up that, we get the closing balance that needs to be transferred to the statement of financial position. But the unwinding of the discount, it's finance costs unwinding of discount environmental provision of 61, like that. Then now let's go to the last note, deferred tax. The last note is deferred tax. So let's calculate our deferred tax. Our deferred tax, we are told that the tax written down value of deferred tax is 25 million. So we'll put 25,000. Then we have got our carrying amount. Our carrying amount is what? Our carrying amount we have got 22,015 for the factory, and also we have got 11,500 for office buildings. So our carrying amount is 33,515. Then we get the difference, and on this difference we'll charge tax at 25%, at 20%. That is deferred tax. So tax at 20%, we say that figure multiplied by 20%. We get that figure. Then we compare that with what we have at the beginning of the year. So as per the TP, the TP will give us the figure at the beginning of the year. So the deferred tax has increased from 1.5 to 1,703, and the movement, or the increase, the movement is 203. That needs to go again here. Deferred tax movement of 203. Now we have adjusted all the notes. Then we need now to find our revised retained earnings. We have now our figure for the revised retained earnings, like that. We have answered that question. Now let's quickly go to the statement of financial position. We have got PPE. We have already have that figure here, 3315. We have got current assets. The current assets, will take them from our trial balance, is 14,700. Then when we add this, we get that this is total assets. Then under our equity and liabilities, we have got share capital. The share capital that we have is 10,000. Then we've got retained earnings that we have revised. We take our figure here, is this one. Then we'll also take deferred tax. We have our deferred tax that we calculated 1,703. Then we will have our environmental provision. We have the figure for environmental provision, that one. Then we will take loan notes. We also have the figure for loan notes, 5015. Then we will have current liabilities. Our current liabilities, we will take them from the trial balance. Then if we sum everything from share capital up to this point, we get total equity and liabilities, like that. This is what was required of us to get full 20 marks, 8 marks for retained earnings and 12 marks just for this one. Please watch the video up to the end, time and again, and until you understand it. Thanks for watching, and if you have not subscribed to my channel, please do so now.